I wanted to talk today about everything that's going on with the refinancing, like actually the payment deferment stuff that you've seen going around on, like, hey, I've got a mortgage, can I defer my payment? Which is trying to make up for the fact that no one's working or people are out of work. Well, a whole bunch of things that kind of led up to here, and I just wanted to share kind of some insight, I guess, that I have from some research I've been doing, and kind of show you the step by step of how we got here. So this all really started with the stock market crash. So once the coronavirus got to the point where markets got jittery, then boom, there's this giant sell-off. And so when equities sell off, all that investor money is like running for somewhere to go. And typically it goes into bonds or long-term bonds. It goes into, things that are considered safe. Sometimes it just goes to cash. Well, one thing it often goes to, oh, hi Kaylee, is mortgage-backed securities. So when the stock market crashed, all this money started flowing into mortgage-backed securities. So when money goes into mortgage-backed securities, it causes the rates, when I say rates, it causes the mortgage rates to drop. And the reason being is you've got all these securities and people start running for the shelves and like, hey, they're running out of inventory, just like you're trying to find toilet paper. And so that means that they get more and more expensive. And so as the mortgage-backed securities price increase, the rates are inversely related to the price of those securities. So that caused rates to drop. So when rates started going down, then everyone got the refinancing bug. Everyone's like, wow, rates are 3%. Oh my gosh, they're 2.8. Let me go refinance. Because of that, like all of the lenders and all of the people processing new loans, they have just they're overwhelmed, right? They're underwater with applications. And so lenders have too many of them. They're like, well, if we've got this much demand, we don't really have to lower rates. So even though the price of mortgage-backed securities was going up because you had everyone buying them, they started to pump the rates back up too because they were just like, look, we've got so much demand, we don't have to lower rates. So that's why we had this kind of bounce. Normally, mortgage rates will stick around for they might move a quarter point or something like that over several months. And in the last couple of weeks, they've been moving as much as 1 to 2 points inside of a week because you're having all this bounce off of all this demand of giant sums of money moving back and forth between mortgage-backed securities, as well as pressure for people to refinance. So now you've got lots of banks and lenders are funding all of these refinances. So now there's actually, it creates the opposite effect. So now you've got this oversupply of mortgage-backed securities. So investor buyers are not buying them fast enough, right? So you get this big price swing, right? Or this big money flow swing. And so this sends the price of mortgage-backed security deposits down, right? So that's when then causes rates to go up. So simple supply and demand mechanics. The Fed at the same time drops the rate to near zero. Now Fed rates are not the same rates as mortgage-backed securities rates. Sometimes people often think like, oh, well the Fed rate is, if they're dropping points to zero, then my mortgage will go to zero. Well, that's not exactly right. So homeowners start asking about refinancing, thinking that, hey, if if the Fed rate is low, then my mortgage rate should be low too. So that also increased more applications that cause applications to spike again. So again, we get more of this bouncing. So this is where mortgage servicing rights come into play. So I got to define this first. So when you get a mortgage, the lender loans you the money to do it. But lenders don't like maintaining those notes. So if I have a mortgage with a bank, like someone's got to keep an escrow account and they've got to figure out how much goes to insurance, how much goes to taxes, how much gets applied to principal, how much gets applied to interest. Okay, a year's been up, the taxes have changed. I've got to send a notice and either refund some of the escrow money or ask for more in the payment. And I've got to do that every year. And then I've got to track who's making their payments. And then I've got to send people to collections and collect late fees and all that stuff. So there's all this, manual work that has to happen in that loan. And banks usually don't want to do that. So they're happy to pay a mortgage servicing company to do that. So once the loan is closed, these mortgage servicing rights companies collect payments and track the loan, and they get paid for that. But it usually takes 3 or 4 years for them to turn a profit on those. So they have to hold on to them for quite some time. So all of these early refinances makes those mortgage servicing companies lose money. So if you have your note for 2 years and rates drop a point or two and you're reservicing it or you're refinancing it, you might be going with another lender. And so that loan gets taken over by someone else and that mortgage servicer then loses money. So that's another reason why those rates have been bouncing back up because those mortgage servicers are like, look, we can't lose money on these things. We have to charge at least a certain amount so that we get paid, and so that people don't swap their loans so quickly that once that happens, then you start losing money. And people in the financial world are, not into losing money. So those mortgage service rates, or the mortgage rates, are based mostly on the supply and the demand of mortgage-backed securities, and they're not really set strictly by the Fed. Now that can influence things in terms of like how much money comes into and out of mortgage-backed securities. There are lots of knobs and levers and stuff like that, but they're primarily based on supply and demand of mortgage-backed securities, and mortgage-backed securities and those mortgage servicing rates primarily influence what the mortgage rate is going to be based on that supply and demand. Okay, so while all of the refinancing caused the value of the mortgage-backed securities and MSRs to drop, when the value goes down, rates go up. So that's where the balance would come from. So here's the other problem, is that at the end of the day, high mortgage rates are bad for the economy, right? Because high mortgage rates means fewer people can buy, less production. The Feds want to keep the economy humming as much as possible. I know that there's a giant wrench in the works with coronavirus, but as a result, the Feds announced a bailout package. And so here's the real rub, is that those mortgage servicers, like legally, are required to pay investors even if they don't collect. So if you defer your payment, then hey, that mortgage servicer still has to make the payment to the investor. Now, most of those investors are Fannie and Freddie because they buy up a bunch of those, and the government. But at the same time, like legally, it's required for you to make those payments. So if those payments are not made, then these mortgage servicers can go out of business, right? Because they just don't have the money to pay. So they go like, okay, well, we close shop. So when you ask for a deferment, what happens is that mortgage servicer, a lot of them are going to say yes because of the current condition that we're in, especially if you say that the coronavirus has impacted me. So if you're asking for that deferment, the deferment kind of canary got out of the cage a little bit early because it seems like a reasonable thing to do, like, hey, let's defer payments and just like put everything back a month to get this thing figured out. But that kind of came out before the government kind of figured out what the real plan was going to do. And right now they're planning to put money back into everyone's pocket by saying like, okay, well, I'm going to give every adult who didn't make a certain amount of money $1,200, and then you can use that to pay your note. And if we only have to do that for 1 month, then that's probably okay and everything would be fine. But this deferment card kind of got out there before that plan was solidified. So now you got people talking about, one or potentially both. So I suspect that many people will have their payments deferred anyway, which, is fine, good or bad. I'm not really entirely sure. But to keep the system humming, it would be like pay your notes. So it just depends on where that bailout goes, because the whole system is finely tuned so that the money comes in and then it goes up the chain all the way up to the lender. Now, what does this mean for the real estate industry? I think that lenders are certainly tightening requirements. So it's not like 2008 where you could get ninja loans and things like that. And I think that the stock market crash has also taken a lot of cash out of people's pockets. So we're gonna see fewer buyers when all this thing blows over, just because fewer people will be able to buy because of the tightening in lending. And certainly people are pulling their houses off the market now, potentially waiting for after the coronavirus thing resolves itself to put things back on the market. But here in Austin, like, we've already got low supply and a ton of buyers. So I would see, at least in the short term, we might see a few more sellers and less buyers because they can't get loans or they've lost some of their down payment ability if they use the market to store their wealth, which I wouldn't recommend. So hopefully that's been enlightening as to kind of where we've gotten to right now in terms of all the mechanics that have come into place that have caused mortgage rates to bounce so much. It's really more about money moving into and out of mortgage-backed securities. And the role that deferment plays in the whole chain, whereas if you defer things, then at some point someone's going to have to pay, and so someone's going to break. It's either going to be people who can't pay their mortgages, or it's going to be the mortgage servicers or the lenders. Like, all the money moves up the chain, so somewhere along the chain someone has to get screwed, and so it's just a matter of who's it going to be. And I think it's a little too early to tell where we're at right now. So hopefully that's useful. And if you got any questions, I'd love to answer them. I love this stuff. I love finance. I love watching the real estate markets and kind of predicting where I think they will go. I can't be 100% certain, but it is fun to guess and put the puzzle together. So hope you guys enjoyed it, and I'll catch you later.